Hi Gaurav. Hi Rahul. We'll wait for Rahul to give us a go ahead. Gaurav, I think, has joined. You can let us know when to start.
Yeah,
Sure,
hi. Sure, Indo.
sure. Hi, Gaurav.
Hi,
Hi,
Gaurav.
Rahul.
Hi, Arindam. We'll wait for 5 minutes for more people to join in, and then we can start the session.
Sure,
In
sure.
the in the meanwhile, what is the format of this discussion? Do you want me to present something, or is it direct Q&A, or how do you want to take it?
So we'll have the Q&A format, and wherever required, if the PPT can be shared, will be better.
Gaurav, you
Okay.
can start with the presentation kind of. You can start with the
No, that's
presentation.
okay. That's
Yeah,
okay. If Q&A works better, so that let's
yeah,
start with Q&A. Yeah,
yeah.
Yeah.
sure.
We'll wait for another minute and we can start the session today. Uh, I guess let's start the session. Rahul, Gaurav, yeah,
Yeah,
I'll just
Yeah,
start.
sure.
Yeah, you're
yes, we
ready? Okay,
can. Yes.
fine. Okay, so good evening, everyone. A warm welcome to all of you joining us today. We are delighted to have you with us for this special session on an investment category that's creating powerful shift in the way portfolios are built. The market landscapes today demands more than just traditional asset allocation, especially where structuring the debt portfolio. We at IMMPL constantly evaluate products basis the risk reward matrix, and that's where SIFs, the special investment fund framework, comes in helping investors navigate volatility while staying aligned with long-term goals. So we need to see, where it's going to position itself between mutual fund and AF. And this session aims to objectively understand where they truly fit in an investor's portfolio. I am Rupa Sudarshan, Senior Manager Client Relationships at International Money Matters, and I will be your host for this webinar. It's my pleasure to welcome our moderator for the evening, Mr. Rahul Jain, Senior Vice President and Head of Research at International Money Matters. Rahul brings years of deep market insights and he will be leading today's conversation. We are also honored to have with us Mr. Gaurav Mehta, Head of SIF at SBI Mutual Fund, the person behind shaping and strengthening this innovative investment structure. So, if you have any questions, we can take it at the end of the session. You can type in your questions in the chat box. So, over to you, Rahul and Gaurav.
Thank you so much, Rupa. Hello, everyone. And finally, we were able to make this so-called SIF. From past 12 months, we have been talking about this. Investors have been holding checks saying, okay, this is something new. Few investors want to explore this product, but the problem is this is completely new to all of us. And the whole idea of the webinar is to understand what are the benefits, who should be investing, how should we invest in. And to start with that, and we have Gaurav. Gaurav heads the SIF. And what I understand, every AMC is segregating this as a specialized different segment of the business. So they have named the segment of this business also separately. They have a separate team also, like how we have in PMSs, how we have in mutual funds. Likewise, my understanding is they have segregated the brand, the team, and Gaurav heads the SIF piece, and he is looking after the SBI Magnum SIF. And to begin with this, Gaurav, if you can just start or help us with the basic, what is this SIF all about? Because we have been hearing there is a differentiation that this brings in over and above the mutual funds, but it is at the mutual fund platform. And that is where the confusion starts. So if you can just help us, how is this on mutual fund you are getting this SIF? If we can start with that.
Sure. So Rahul, first of all, thanks for having me, and good afternoon, everyone. Before I answer this question, you're right that we've separately segregated this brand, and which is why when you think of the SIF being offered by SBI Mutual Fund, you will see it under the Magnum brand name. So Magnum SIF brought by SBI Mutual Fund. And again, coming back to your question on how this is different from mutual funds while still being within the mutual fund structure overall, is the fact that it allows you a lot more flexibility to deal with derivatives. So mutual funds, I think conventionally, as we all know, have been pretty much long only products where there is a large component of returns which is tied to the overall market doing well. Whichever segment that the fund operates in, the underlying market doing well is one big component of the overall returns, and then there is an alpha that fund managers try and create over and above that. Versus which the difference in SIFs is that you can go short. You can short up to 25% of the assets unhedged. What does that mean? What that means is that I may not own stock A, but if my view is that stock A will decline and I want to benefit from that view, then I can short stock A in futures or using options or a combination thereof and benefit from the price decline without actually owning it in the portfolio. Now, what that essentially does is that so for example, if you're using that 25% short window, and the SIs do not allow you to take any leverage. So to that extent, if you have 100 rupees of assets and if you use 25 of that to go short, which is the maximum that you can use to go short, then you're left with 75 on the long side. But 75 long, 25 short means that the net market exposure comes down to 50%. So to that extent, your linkage to overall market reduces quite significantly here versus in a conventional mutual fund. You can benefit from mispricings by going short on stocks even on the way up. And to that extent, this creates a risk reward proposition which is very different from a conventional mutual fund. And 25% unhedged shorts is one important leeway. The second important leeway here is that you can use options also in a much more flexible fashion. So today, mutual funds, for example, can do call writing, what you call as the covered call strategy against their existing stock positions, etc. But that is very restrictive. You can only do it on 15% of your portfolio. You can do it only on Nifty stocks and so on. Versus which your ability to use options is significantly higher in SIFs. So I think in a nutshell, SIFs allow you to use derivatives much more flexibly than mutual funds, and in a way that helps you create risk reward propositions which are very different from a long only product, which tends to be a mutual fund. The good part, however, is that this is within the mutual fund structure, which means be it taxation, be it regulation, be it transparency, be it liquidity, all the good aspects of a conventional mutual fund still apply. It's still very well regulated, very transparent, very tax efficient. But you also get the flexibility of using derivatives much more flexibly than mutual funds. And the last difference, I think, which I'm sure we all already know, is the fact that just like the regulator wants a segregated brand name for SIFs, they also want a higher ticket size. So to that extent, 10 lakhs is the minimum to start your journey in the SIF of a particular AMC. So I think those are the few differences versus mutual funds. A lot more flexibility, but without losing all the benefits of a mutual fund.
Sure. So, Gaurav, you said derivative is something that you're using and you're saying shorting, but we have a plain vanilla arbitrage fund which is available. And the underlying thesis for that fundamental concept of arbitrage itself is 100% derivative position. And yet it is like a linear growth trajectory, a debt portfolio composition that is there in industry for the client. So you're saying when you're shorting, you can short directionally. Otherwise, it is hedge in your portfolio. So these are without hedge position, you're saying shorting? Because otherwise
Exactly.
derivatives are allowed in arbitrage as
Yes,
well.
so mutual funds can use derivatives to hedge their existing positions, and which is what arbitrage also does. And in an arbitrage fund, you short futures of stocks that you already own in the cash segment, and in a way, you're trying to just play on the spread between futures and cash, because on the settlement day of derivatives, they converge by definition. So to that extent, you earn a pretty much, I won't say risk-free, but very low risk returns. But then to that extent, the returns also tend to be lower, given that there is, it's pretty much safe instrument. Versus which the difference here is that you can short stocks which you don't own also. And
Sure.
to that extent, the last few years we've been all hearing about things like a lot of flows coming into mutual funds that leading to certain price discrepancies, especially things getting overheated and overvalued versus their fundamental value. So mutual funds had no way to express a unhedged short view on things that they thought were expensive and ought to come down. SIFs allow you to do that. They allow you to short stocks that you don't own in the cash segment. You just play a view on that stock declining and coming back to fundamental value on the way down. And to that extent, this is very different from arbitrage or any other mutual fund for that matter. And the second difference that I also alluded to earlier was that you can use options also significantly more. There's a significant leeway on the usage of options also here, which doesn't exist today in conventional mutual funds.
So how is it different from, because you're shorting, which means there is a possibility of high return and could also be having slightly higher risk. Now we have learned saying, okay, there is a positioning of arbitrage, there is a debt fund, and we also have long short in the market. Now considering this is long short, this is also shorting. So if you can help us, long short is at the AIF platform where the minimum ticket size is at 1 CR. Now, how different is it from long short AIFs, which are there? And now we have arbitrage. I understand the risk is also higher. Now, how much is the higher risk which is there in this strategy? And how is it different from the long short plain vanilla funds at the AIF level, which is available in the industry?
Sure. So let me, answer this question in two parts. One, contrasting it versus conventional arbitrage funds. I'll take that up later. But before that, to your question on how are these different from the long short AIFs, I think if you think of AIF as a construct, it provides a bit more flexibility on the use of derivatives. For example, in an SIF, you cannot leverage. You cannot exceed 100% of gross assets in terms of your deployment. In an AIF, you can take leverage up to 2x. In an AIF, you can, practically run a full long short portfolio or a short only portfolio or, a long only portfolio, any combination. So to that extent, within that 2x leverage, what you do is also very flexible. Versus which in an SIF, you cannot exceed 100%, so you can't take leverage. And B, as I said, you can only do 25% unhedged shorts, not more. And
Okay.
you can use options in a bit more flexible with a bit more flexibility, and that can sort of also help. But from an unhedged shorts point of view, cannot exceed 25%. So to that extent, when you think of the use of derivatives here, it's more flexible than conventional mutual funds, but less flexible than AIFs. That said, I think when you think of uh, a construct like SIF, in an AIF, every transaction has a tax implication because it's a Cat 3 trust, for example, where most of the
Right.
action happens, right? So not only, for example, any stock that you buy, sell, you pay short term, long term, depending on what the duration of holding of the stock is. Anything that you do on derivatives in an AIF gets taxed at maximum marginal tax rate, which again the fund pays. So the investor's tax rate doesn't really matter. The fund pays the maximum marginal tax rate. Versus which, when you think of an SIF, this is like a conventional mutual fund in the sense that whatever churn happens within the wrapper of the mutual fund, the investor has no direct tax implication because of that. So I might be
Right.
buying, selling, going short, and so on, but the investor doesn't have to bother about transaction level taxes. There are no taxes at individual transaction levels, and whenever the investors eventually redeem, uh, that's when they pay a tax depending on how the fund is structured, whether it's structured like a equity fund or like a debt fund, which is exactly how you do it for a conventional mutual fund. So only on investors' redemption do you end up paying a tax,
Mhm.
versus an AIF where every transaction has a tax implication. So to that extent, even with less flexibility on the use of derivatives versus AIFs, the tax efficiency makes it, a very strong advantage in favor of SIFs. And then on top of that, if you add other advantages, for example, there is 10 lakh minimum here versus 1 crore in AIF. This is much more liquid, to the extent that we publish daily NAVs in the scheme that we are managing right now and so on. And again, the usual sort of transparency of portfolio disclosure and everything, all of those things make it, tilt in favor of SIS versus AIS. Now, to your question on how is the risk reward different, I think the risk reward, again, SEBI has allowed 7 different categories within SIS, and
Right.
each AMC can launch exactly not more than one fund per category. So on a max basis, you can have 7 SIF strategies per AMC. And of those
Mhm.
7 strategies, the regulator has said that 3 of them are in equity. And again, there are well-defined definitions to it. One
Sure.
is an
Yeah.
unconstrained equity long short. One is a X top 100 long short, which is more skewed towards mid caps and small caps. There's a sector rotation long short. Then there are two hybrid categories, which are, multi-asset in nature. And then there are two debt categories. So again, depending on which category of fund you're looking at, it'll have a very different risk reward versus conventional AIFs versus, arbitrage funds, debt funds, and so on. The strategy that we've launched thus far is within the hybrid long short category, where you can invest in equity, you can invest in debt, and you have to have minimum 25% in each of them. And the way we have structured our product is to have equity taxation, and to that extent, 65 to 75% of our portfolio is equity, and 25 to 35% is debt. But this equity portfolio is something where we use options to cover our risk, not, completely hedge it out like an arbitrage fund, but to mitigate risk to some extent. And what that means in terms of risk reward characteristics is that it makes it a bit more variable versus arbitrage funds. But in lieu of that, we are also trying to generate a decent outperformance versus conventional arbitrage funds.
Okay.
So to that extent, this is comparable to the long short AIFs because again, our idea here is to control risk, to control drawdowns, and so on.
Mhm.
But this is a bit more variable, and obviously that we're doing that with the tax efficiency of an SIF versus a conventional AIF. But versus arbitrage and debt funds, our idea here is to in a nutshell generate debt plus returns with equity taxation, and which entails a bit more risk than a conventional arbitrage fund.
Sure. So you're saying long short arbitrage are not tax efficient because this strategy will be taxed at the highest tax rate, which is maybe 40-42%.
Long
But
short
here
AIF.
you will not be paying any taxes. That is one big difference. And because I think, and you talked about there are 7 different categories, and this is one of the category that you have started with, which means there are guardrails already defined by the regulator which is very loosely used or which is slightly more a free hand to the AIF platform. Maybe on the leverage side, they can have a better or a higher leverage, and you will not be doing that. To that extent, it makes it safer. So to that extent, your returns will also be in the band, in a tight band, on the upside or on the lower side. So that may be because of the mutual fund pedigree, mutual fund platform. Is that the reason that they are looking at a lot of retail investor, a lot of small ticket size investor they want to bring in? That's the reason they are giving these guardrails. And you are following the same. And over and above this, anything SBI is following, because this is the strategy that you are managing, that you are saying, okay, market practice is this, as SEBI has said this, but you are following maybe one layer higher on in terms of making sure the guardrails are intact.
Right. So I think you're right that the regulator has put in a lot of guardrails already, and much more versus, let's say, an AIF. And I think the reason for that is extremely simple. That while there are hardly any lower limits on how much a mutual fund investor can invest, it's a very retail ticket size. AIF is 1 crore, where the understanding is that it's a sophisticated investor who understands risk, and to that extent, the regulator doesn't have to put in very strong guardrails there. Versus which SIF is 10 lakhs, right? So it's somewhere in between. So to that extent, yes, a bit more flexibility versus mutual funds, but they also want to make sure that there are enough guardrails in place to sort of protect this investor, because a 10 lakh ticket size doesn't necessarily mean that you are as sort of high net worth as you are in an AIF strategy. That said, and to your question on guardrails from our side, I think in this strategy, what we're doing essentially is that for all our equity exposure, we are trying to use options in a way that it reduces risk automatically. So, for example, for most of our equity exposure, we end up buying put options, which gives us protection on the way down. But buying put option entails paying a cost. And to
Right.
fund that cost, we also sell call options against these positions. So in a way, most of our positions will have call options sold against them and put options bought against them. Uh, Selling a call option would limit our upsides to some extent, but buying put option also gives us protection on the way down. And this
Right.
combination means that our return band gets well defined, right? To that extent, big moves in the market, either on the way up or on the way down, do not sort of lead to a commensurate up move or down move in the NAV of the portfolio. So, and again, our idea was to start with something which is conservative, which is able to add a decent outperformance over arbitrage funds, but without carrying the same risk that comes with conventional equity-linked products on the mutual fund platform. So I think that is an important guardrail inbuilt within the strategy. But beyond that, the fact that this is multi-asset in nature, to the extent that, about two-thirds of the portfolio is equity, one-third is debt plus REITs, in which that also provides a degree of stability to the portfolio. And
Yeah.
beyond the strategy construct itself, I think the fact that this is following the same regulatory and compliance construct as mutual fund. I think that helps. We have a strong risk team. We have risk templates for all of our strategies. That helps. We have an investment oversight of the investment committee, like all of our mutual fund schemes. I think all of those things put together ensure that not only does the strategy, I mean, so there are three levels of guardrails here. One is the regulatory guardrails, second is the compliance and risk framework, and third is the strategy level inbuilt guardrails. All of that put together, we think should ensure that investors are not caught on the wrong side of things.
Sure. So since we are comparing this or positioning this as an arbitrage plus, and for arbitrage fund, there is some kind of a ballpark estimated return from the fund manager or from the market that one can assess at the beginning of the series, saying, okay, this is what you are expecting at a fund level, plus minus maybe 10, 20 basis point. So in this, since you also mentioned you are using call and put, which means you have a band now available because stock prices cannot, or your portfolio cannot fall below a certain level. Your portfolio can also not go up beyond a certain returns, certain range. So what is that range that you foresee in your fund? And I'm sure it will keep on changing depending on how your portfolio get changed over time. But as we speak, since the first month portfolio is out, going by that, what is the range you foresee for the portfolio like this in the SIF space?
Right. So, when I look at this strategy, there are three components to returns. As I said, one-third of the portfolio is debt plus REITs and InvITs. That gives some stable returns every month.
Yeah.
Only two-third is equity. Within that equity, I talked about this option structure where we are selling call options and buying put options, but we are structuring this trade in a fashion that we, on a net basis, receive options premium. We don't pay options premium. So that is the second component of returns, which is that the options premium that we collect every month. And the third piece is that within this band, if stocks go up, we make some more money. If stocks go down, we lose some money. So with those three key drivers of returns, the first two drivers on a steady state basis are always working in your favor, which is that you're always getting something from options premium, you're always getting something from fixed income and recent bets. The last one-third is something which is unpredictable, which is that markets can go up, go down, and that's something that you can't foresee at the beginning of a derivatives contract series or at any point in time for that matter. But because we've made sure that it only moves within a band, the variation doesn't tend to be a whole lot. Now we've been live for only about 1.5 months. Over this period,
Right.
we've seen like I think closer to 35 basis points drawdown on the NAV. I think Nifty over this period we have seen at least 1.5 2% kind of a drawdown. And then we have also done a longish backtest on this strategy going back last 15 years, and there our experience was that uh, we should be able to generate, again, this is all backtest and you should always take backtest with a
Absolutely.
pinch of salt. But there are experience suggests that you should try and target 2.5% kind of excess returns over arbitrage funds. And that comes with
Okay.
some degree of variability. What that variability is, in terms of standard deviation, we found that the standard deviation on monthly returns is about 5% annualized, which is again
Sure.
16, 17% for the Nifty. The other way to look at variation is to think of the drawdown risk. Again, we saw that over this 15-year period, COVID was the maximum drawdown, and that drawdown was somewhere in the range of mid-single digits. During COVID period, Nifty had drawn down by about 40%. Versus at 40%, this is mid-single digits. So to that extent, when you think of some of these risk characteristics, you will find that they are very similar to for example, a CRISIL composite bond index, right? A bond benchmark. Uh,
Right.
so to that extent, the risk parameters are similar to a bond benchmark. But from a return point of view, as I said, the attempt is to add about 250 basis points to arbitrage returns. So the returns are debt plus with debt-like risk and equity taxation.
So if on a next 1 year basis, if arbitrage is expected, say 6% return on a pre-tax basis, this fund you foresee generating at least around approximately 8.5% return, again on a pre-tax basis. Is that
Right. So on a
right?
steady state basis, that should be the expectation. That said, as I said, there is a degree of variability in returns here versus arbitrage. So
Mhm.
to that extent, and there is a 5% standard deviation. So to that extent,
Right.
that 8.5, 9% number in a bad year, if you just think of it in terms of 5% standard deviation, in a bad year, that 9 can look like 4, 9 minus
Oh,
5.
right.
In a good year, that 9 can look like 13, 9 or 14, 9 plus 4 or 5. So to that extent, there will be this variability, but by and large, I think what you said is correct. That from an expectation point of view, that should be the expectation.
And to reduce this, incorporate the standard deviation is what is the horizon so that this smaller volatility, which is part of the strategy, will not disturb the investor portfolio. So what is the
Rahul,
minimum?
sorry to interrupt, but I don't know if it's a problem at my end or what, but I can't hear you very clearly now.
Hello,
Yeah,
can
now
you
it's
hear
okay.
me?
Yes.
Okay. I'm saying consider now looping in the standard deviation because there is a 5% standard deviation. It is important to match the time horizon of this investment. What, according to you, is the minimum time horizon? Not from the exit load standpoint, because I think exit load is only 1 month for this fund, but actually, how much should be the ideal time frame for the investor to invest in and think about this investment? And long term is again beyond 3, 4, 5 years, you may want to get into hybrid funds and pure equities and stuff like that. But considering this is arbitrage plus, we say arbitrage plain vanilla 3 month plus. Now, this fund, how do you position it?
Right. So I think I want to first start with the caveat that unlike arbitrage, which people are used to seeing positive returns every month, in this product you can have some negative months as well. Although
Sure.
our attempt is to not have very large negative months through the use of options, but some negative months here and there are possible. But what we found out during our backtest was that if you hold the product for 12 months or longer, then chances of losing money are very negligible. Right. So on a 12-month basis, even on a worst case basis, you should still be able to end with a flat returns, if not better. That said, to achieve that 250 basis points above arbitrage returns, we think about 18 to 24 months is the minimum time frame that investors should look at. And over that sort of a time frame, the chances of achieving the intended outcome from a return point of view, that probability increases quite meaningfully. Now, does that mean that as an investor, if I think of a 2 year time frame in this product, then I'm locked in for 2 years? Definitely not, because this is a product that gives you all the flexibilities to get out whenever you want to. What are
Right.
the constraints usually to getting out of a product? The most important constraint is, if I've invested 100, will I end up redeeming 70 when I need that money? And in this case, the drawdown risk is, as I said, to the extent of mid-single digits. So to that extent, that's not a big deterrent. You will still be able to get out with a big chunk of your money when you need that money, even in the worst case. B, from a tax point of view, this is structured like equity. So if you need that money in 6 months, you pay 20%. If you need that money in 12 months, you pay 12 and a half. So again, that is not a big deterrent. And thirdly, from a liquidity standpoint, this is a daily NAV product, and there is no exit load beyond 1 month. So to that extent, again, that is not a deterrent. So all of those things make it a very flexible product for you to exit whenever you want to. But to start the journey, I think you should think of 18 to 24 months as the right time frame to be invested in this product.
So, in what scenario you have seen as per the back testing, as per your study that you have done before launching this? One is if you can highlight and if you have any slide or anything, in what market condition there was a drawdown? You mentioned mid single digit. Uh, I understand maybe 4 5%. One is how many times this has happened, what is the data to that? Back to back, how many months it has gone down? If we can just elaborate on the risk part of it, on the worst case scenario, was it because of the COVID, some 2008 kind of a crisis, debt crisis, volatility going up? So these are few factors which are driving this derivative piece. Combining all this, if you're saying market's going down 40%, 30%, and the strategy is only down 4%, and 4% down only for 4 months, and then it has recovered, was the recovery sharper? So if you can just highlight in what circumstances this can show us a drawdown, and then how many months or what market condition does it take for it to recover?
Sure. So first of all, if you, again, coming back to the three drivers of returns, right? The first is one third coming from fixed income and REITs and WITs. The remaining
Mhm.
two thirds is equity, of which one component is options premium, and the other component is linked to market direction. Now, usually the first two components should be positive, right? And to that
Right.
extent, those are not two components that should lead to any drawdown in the portfolio. And again, just to elaborate on the debt piece, because debt, the perception usually is that is risk free, but it's not true. So which is why what our idea in this product is to work with a simple methodology that, or the simple principle rather, that debt is limited returns, unlimited risk, right? So any risk that you ought to take,
Right.
you should take it in equities. It's liquid, you can course correct, you can move out. In debt, once you get stuck, you get stuck. So our debt allocation is very conservative. So we are not taking too much of duration risk there. We are not taking too much of credit risk there. And what I mean by
Sure.
that is that normally our portfolio our portfolio will not invest in securities which are more than 3 years in terms of maturity. So that reduces the duration risk on the debt side. And similarly, in terms of the credit profile, these investments are either in AAA papers or government bonds. So again, to that extent, we aren't exposing the portfolio to too much credit risk. So which is why I said that the debt piece for us should be conservative and should usually be positive. Options premium, as I said, should be positive. The third piece is obviously the market linkage, and there I think we are buying stocks and then using options around that as a cover. But if markets keep declining, then obviously that's a stress scenario for this portfolio, because then whatever you make from the first two components, you lose that and more in the third piece. And which is why the stress scenario for this product is when equity markets are tanking big time. But again, thankfully, through the use of options cover, which is what we sort of, I sort of alluded to earlier also, even during COVID, when Nifty drew down by 40%, our drawdown was limited to mid-single digits. So, conservatively think of it as 6% kind of a max drawdown, right? Somewhere in the 5 to 6% ballpark. And
Yeah.
the way that happens is that the first two components deliver positive returns. The third component drags, but because you're using options, it drags much lower than the overall market. In a sideways market, like let's say the past 12 months, for example, this third piece will give you nothing, right? It will not make you a lot of money. It will not lose you a lot of money because there is no direction. But the first two
Right.
pieces are still working in your favor.
Yeah.
Now, to your question on how many times have you seen those 5, 6% drawdowns? I think COVID was one instant. Beyond
Mhm.
that, we've seen 2, 3% kind of drawdowns, but not more. And after COVID also, because the overall market recovery, etc., was so swift, it took us about 2 to 3 months to recover from that drawdown. But I think on that note, just one thing to highlight here is that just like there aren't that many big negative months,
Mhm.
similarly on the way up also, this is not a product which will give you market upside, right? So if there are months
Correct.
where market suddenly shoots up, the upsides will also be capped because you're also selling call options against your position. So to that extent, you should think of it as a product where you're trying to mitigate the band of returns to a large extent, not completely, but to a decent extent, while also not completely letting go of the equity upside.
Sure. And what have you seen in good months in a normal gradual up trajectory market? What has been the normal return, assuming those exceptional drawdowns are not there in the market? Exceptional as in double digit. I'm saying, say, above 15% or 20% corrections, assuming in those years are not there. In normal cases, what have been the returns? Are you able to touch, say, maybe 9 to 10% in those cases as per your historical backtesting?
Yeah, so I think if it's a mildly rising market, that's in a way the best case for this strategy, because
Okay.
you make money on all three components. Because
Mhm.
the third piece, which is market linked, if there are sharp up moves, then because you've sold the call option, your upsides will get capped, and the market returns will be front loaded in a few months. And then
Right.
the rest of the period you will just be making returns on the first two component, option premium as well as the debt portion. But if it's a mildly rising market, then every month you make money from the first two components and you make some money on price. Next month again, it's a mildly rising market, you make money on all three components. So
Mm.
you're right that in a period where it's a mildly rising market, steady state, then chances of touching just about double-digit returns also exist.
So apart from the market risk, any other execution risk you foresee in this strategy?
No, obviously. So if you're dealing with derivatives, especially options, options tend to be non-linear in terms of their overall risk-reward characteristics, right? So to that extent, thankfully in this case, we are making sure that we only sell call options and buy put options against our existing exposure. There's no naked options positions there. But there again, you have to, be careful of a few things like do you have sufficient cash to meet the daily MTMs in the options positions? Do you have sufficient margins to make sure that the derivatives position is amply covered from a margin requirement point of view? In expiry week, you may be rolling over your position, so you may need a little higher margin and so on. But I think in this case, the good point is that because 25 to 35% of our portfolio is in debt, which is a mix of AAA and government bonds, and some AAA bonds are also marginable, and almost all
Right.
government bonds are marginable. So to that
Correct.
extent, this debt piece itself works as a big enough cushion for any margin requirements that may come through on the derivative side. So to that extent, those are not big constraints, so to speak, but I think some things to keep in mind, which is very different from a plain vanilla long only strategy. When you're
Right.
dealing in stocks, there are other nuances like you know stock options tend to be physically settled. So you have to, well, again, in this case, you own the underlying stock, so there's not something to
Yeah.
worry about, but there are costs associated and so on that you need to manage. Execution, right? Do you have sufficient liquidity in options in the stocks that you're dealing with? So those are a few things that we have to keep in mind, which is very different from a conventional long only fund. But
But
I mean, good
isn't it
part of
already there in the system? In arbitrage funds, for example, there is this massive book which is running, which is run by mutual fund industry. Every day there are flows coming in, there are massive redemption coming in during advanced taxes. But don't you see that's like a system which is in place? But apart from that, anything else which can be something which you feel could be a challenge, or you see no, this is all fine in terms of the regulatory framework?
I think from a regulatory standpoint, I think beyond that, we are pretty sorted.
Okay.
The good part about SIF regulations also is that there are certain transactions that go as offsetting transactions. So, for example, when you own the stock and you sell a call option against it, that doesn't count as exposure because it's against your existing
Correct.
position. So it's offsetting. So it's
Correct.
very capital efficient in that sense. Versus which, if you were to sell naked options, then the entire notional value of the underlying gets counted as exposure. So I think those are some things
Correct.
that we're trying to sort of optimize on. But yeah, I think
Sure.
that's pretty much it with respect to the
So I
risk.
was looking at portfolio. This is the first portfolio. I don't know this is going to be the style that you're going to manage. I don't see anything which is unhedged. 100% of your portfolio are you currently
Rahul, sorry, I'm
just.
again losing you.
Hello, can you hear me?
Yeah, yeah.
Okay. I'm saying I was looking at your portfolio. Not sure if this is the style you will run in future as well, but whatever information I had, I saw all the stocks that you are holding are hedged by call and put. Is that right? Is this how you want to run it, or you see there are positions which will be uncovered, unhedged in the portfolio? And I was looking
I
at the
think.
premium, for example. There was some close to 4.5 CR, or which is 4.5% of the annualized premium that you have got, which is where the alpha comes in. This comes in the third bucket. Two buckets are standalone, and the alpha that you have got, which is the premium that you have got by getting into a call and put, is say 4.5 or 5% annualized. So is that what you're aiming at? Because I saw some 4.5 CR of premium that you have got on a net basis.
Right, so I think that options premium number itself will change depending on how the underlying itself has moved up or down. But on a net basis, our idea is to capture about anywhere between 80 basis points to 1% of premium every month, and which in turn
Okay.
will translate to something like 10% or thereabouts on an annual basis. But would that directly mean 10% returns coming from the equity side? No, because the equity portion is an interplay of options
Correct.
premium and the underlying movement also, right? So
Yeah.
in security, you would have collected the options premium, but the stock would have fallen significantly, and still you would have ended up with a negative payoff. So it's a mix
Correct.
of those two. But our idea is
Sure.
that between the underlying equity and the options premium, we should be able to target 12% or thereabouts from the equity portfolio on a steady state basis. Now, you would say that 12% is something that you in any case generate from a long only portfolio, right? So then what is the advantage here? The advantage here is not so much in terms of us trying to generate anything extra versus an equity portfolio. The advantage here is that reducing the variability of that return while not compromising on the actual return number, right? So generating a steady state 12% number from equity without necessarily seeing a lot of whipsaws, I think that is what we are trying to aim at. To your first question on will all the stock positions be covered through the use of calls and puts? By and large, yes. But what we've said is that up to 10% of the portfolio can be in unhedged equities. And what I mean by that is, these will be things like special situations, right? Some specific event that's unfolding. For example, recently there was this Infosys buyback where we participated
Okay.
in. There can be a
Okay.
merger arbitrage opportunity. At some point, HDFC Bank merged with HDFC Limited. There was a pre-announced swap ratio, but the actual prices were still in deviation to the swap ratio. So then you buy the one which is undervalued, the short the one which is overvalued, and play on that spread. So some of these special situation trades around buybacks, merger ops, open offers, some of those things will fall in that 10% bracket where we may not use options. Very opportunistically, where we think that there is a significant price disconnect in an IPO. Again, we are not playing IPO for the frenzy of it. We'll be very
Right.
selective there. But in very rare cases where we see that there's a big disconnect between what we think the fair value is and where the IPO is coming at and it's mispriced, we will do some IPO allocations as well. But all of that, whether it's special situations, these IPO mispricings, all of that will be part of this 10% bucket, not more. And in all of these
Sure.
cases, our idea will be to not be positional about these stocks, right? So as
Right.
soon as the event gets over, the security gets listed, the exit window opens, you just sell off and move on. So this is all tactical opportunities around a specific event. None of it is positional in nature and capped at 10% maximum.
And no taxation on this when you're playing on this trade.
No, obviously.
No
So
taxation,
yes,
obviously. So these are absolute return trade in a way, and with certain timelines in mind, saying, okay, arbitrage, sorry, Infosys is a 2 month play, could be
absolutely.
a 30% acceptance, 20% acceptance, or
Yeah.
maybe open offer could be a 3 months play. So those are the things that you're saying. To that extent, it can give mark to market marginally, but end of the tenure of this deal, you will make absolute return, likely to make absolute return.
Absolutely. So these are relatively low risk opportunities overall.
Or maybe add alpha to the portfolio.
Absolutely. For example,
Because you
Infosys.
will not get into 6% deal, 6% annualized deal in such special situations.
Yeah, I mean, sometimes you can get 11, 12% annualized also, which is what we ended up getting in Infosys, for example, which was an extremely low risk trade.
Right.
Good part is that conventional mutual funds cannot do some of these things, and to that extent, you can do it.
Sure. So, from my side in terms of what is investor?
Rahul, again, the same issue is coming on.
Hello. Can you hear me? I don't know what is
Yeah, now it's better.
Yeah, better.
Okay. Who are the investors who should be looking at this sort of this strategy? What according to you is the next set of audience for?
No, Rahul, again, I think maybe you'll have to be a little closer to the mic.
Hello, hello. Can you hear me?
Yeah.
I'm saying type of investors who should be looking at this strategy. who should look at this strategy?
I mean, I would think that any investor has an allocation where they want to generate debt plus returns with equity taxation, right? Something which can, with a degree of comfort, without taking a lot of risk, beat inflation on a consistent fashion. Now, for more conservative investors, this allocation is much higher. For more aggressive investors, a large part of their portfolio is in growth assets, and such allocation is lower. But I think practically anyone who's thinking of an absolute, not absolute return is the wrong word to use, but a low risk way to generate somewhere in the vicinity of not double digit but a tad lower than that return, with a degree of tax efficiency. I think this is the right product. And I think today there is
Sure.
a lot of money that's going into long short AIS to achieve that. But with all the tax inefficiencies that exist in that structure, getting to a let's say 7.5, 8% post-tax outcome is not very easy. So here, if you're thinking of 2.5% over and above arbitrage with equity taxation, you can think of a number of that sorts without bringing in a lot of complexity in your life.
Sure. I'm also trying to tag along few questions which are there. So in the rising market, mildly rising market is where the strategy has been working. But what about the volatile or a sideways market? What could be the returns? Because arbitrage fund can still be um, maybe a 7% return, for example, hypothetically, and that there's a very, very tight band for arbitrage fund. It doesn't matter too much in a crash market or a bull market. The variability is maybe 2%, but in this the variability can be very high. But more specifically in volatile and sideways market, how does this strategy looks like?
Right, so I think two things here. First, from a sideways market point of view, as I talked about, the three components of the returns. The sideways market is essentially where you make nothing on direction, you lose nothing on direction, but the options premium piece and the debt piece is still working in your favor. So with that combination, you should still be in the arbitrage ballpark, if not better, maybe even better.
Okay.
In a very sharply falling market is where you can generate returns which are lower than arbitrage, and you will do that in a sharply falling market. But as I said, if your investment time frame is 12 months, you getting into the negative territory is going to be a very outside risk kind of thing, right? In most cases, even in the worst case, you should not do that. And when you hold it for 2 years or longer, then your chances of beating arbitrage over that time frame increase quite considerably. And as I said, we are working with a 250 basis points kind of a number as our target. We'll achieve that or not is a secondary thing. But conceptually, if you think of it, if you're trying to generate, so arbitrage, I think on a steady state basis has been 6.5% kind of a return product, right? Pre-tax.
Correct.
So if you're adding 2.5% returns on top of that, that is like adding at least 33% extra returns, right? Now, to get that 33% extra return will mean you have to increase the band of variability. And
Absolutely.
and which is something that you will have to live with in a product like this. But how much is that band of variability? I think, as I said, 5% is the standard deviation on monthly returns, which isn't a whole lot, right? This is very comparable to a bond kind of an index. So to that extent, it's not that you're taking a lot of extra variability to generate that return, but yes, some extra variability versus arbitrage is bound to be the case, which means that in on a month-on-month basis, even sometimes on an annual basis, you may not look as well as arbitrage, but such instances are going to be few and far.
Sure. Sure. So we also have, so you're saying in terms of returns, say 6.5% to 7% on arbitrage to 2.5% on this. And the challenge we have as an advisor is giving debt allocation in a tax efficient manner. Because earlier we were giving debt funds with tax benefit, but now the tax benefit is gone away. Money is going only in arbitrage fund. Any other substitute, I know this is not related with SIF, but this product we are trying to position saying, can it be arbitrage plus? At the same time, we want to maintain debt allocation. Anything else which you feel is a substitute to debt, and this is a right comparable to that? Because we are all comparing with arbitrage, but
Right.
actually debt is also giving 7% minus 30%.
Right. So I think, we did a laddering on risk reward. And from our point of view, again, I'll remove debt here because debt is tax inefficient. From an equity taxation point of view, it sits right in between arbitrage on one side and equity savings on the other side. Right?
Okay.
Equity savings is a hybrid product on the mutual fund side, which in a typical equity savings fund, you will see about 30-35% of unhedged equity exposure.
Correct.
So this is somewhere in between, right? Which is that equity savings with 30-35% equity exposure and the rest of it being in largely arbitrage and some piece in debt, it does need markets to do well to deliver anything significant over and above arbitrage funds. Versus which here, because of that options premium component, even in a sideways market, you can generate decent returns. So I think this is a product which sits right in between, where if you are accustomed to the stability of arbitrage, but settling for 6.5% returns, versus which you taking unhedged equity exposure in an equity savings fund to deliver double-digit returns. And that
Right.
was a big space we thought, and which is why this was the first product that we decided to come out with. That was a big space, and not a lot of investors were comfortable directly graduating from arbitrage to equity savings. So we thought that that's a wide step. So you need a sub step in between so that you take on a little more risk than arbitrage, but not as much risk as the hybrids on the mutual fund platform, and yet try and generate something which is much more respectable than what you would in an arbitrage fund.
So in the pegging order of risk, this is the most safest in SIF, this strategy, or
Right. I
there'll
mean,
be
so if you look at the other, so I mean, there are two debt categories where, depending on how you structure it, you can get something which is safer. But unfortunately, that's going to be debt taxation. But when you think
okay.
of it from an tax efficient point of view, there are two hybrid categories. This is the hybrid category where you largely are in equity and debt. Then there is an active
Mhm.
asset allocator long short where you can do commodities also to a large extent, which I think by definition is going to be more aggressive than this because bringing in
Okay.
commodities means more risk. And similarly, the three strategies on the equity side, again, by definition, are going to be more aggressive than this. So to
Sure.
that extent, if you remove the two debt categories, which are tax inefficient, of the remaining five categories, we would think that this is the most conservative.
Sure. So in SIF, if someone is looking to take exposure, try it out going by what is offered. This is the safest tax efficient product available relatively.
Absolutely.
By any chance, is there a possibility to get what is the expected return and investor is now ready to put in not 12 to 18 months, but maybe 24 to 36 months? So that removes your standard deviation variability that you have been talking about, assuming that is now sober down with a 3-year holding. In that scenario, what is the return expectation you foresee? Is there a possibility to get some numbers?
No, as I said, I'll go back to what I've been saying that 250 basis points over arbitrage is what our return
Okay.
would be.
Sure. So arbitrage has been closer to 7%, I would say, in the past. So this can potentially be, if we go replicate the same thing, could have been 9 to 9.5% pre-tax. Okay. There is also one question which is on can we simplify and tell the difference between mutual funds and SIF? And in continuation of it is what do you mean by shorting the stock? So in nutshell, if you can just explain how can you short it without owning it? Because
No,
ideally
so
you can
yeah.
sell if you are owning it.
Right. So if you don't own it, the simplest way to short is through futures, right? So, for
Mhm.
example, let's say HDFC Bank will have a future which trades at a slight premium to HDFC Bank and it moves in a linear fashion to the underlying stock price. So you short that future. If the stock price declines by 5 rupees, the futures price also more or less declines by 5 rupees.
Right.
When you short, the decline works in your favor, up move works against you. If the stock declines by 10 rupees, you make 10 rupees through that short. So it's a very linear instrument. So futures is the way you express that. There are certain strategies that you can do in options also. For example, buying put options also helps you make money if the stock falls. But the simplest of all is to short future of the underlying stock.
Yeah. And then also,
Rahul.
since, hello, can you hear me?
Yeah, yeah.
Hello. Okay. I'm saying there is also a question. Can you explain the difference between mutual fund and SIF in simple
Rahul,
terms?
same issue. Rahul, if you can come a little closer, there's some audio issue.
Okay, if you can. Okay. Hello. Gaurav, can you hear me?
There's some disturbance.
Yeah.
Gaurav, there is one more question, which is the
Yeah, yeah.
difference between mutual fund and SIF
No, I think I
in
talked about
simple.
this at the beginning of this thing, right? Where mutual funds are largely long only products which do well when the underlying asset class does well because you can't do unhedged shorts there, you can't use options very flexibly there. So the use of derivatives through 25% unhedged shorts or writing call options, buying put options, all of those things make the use of derivatives a lot more flexible in an SIF versus a conventional mutual fund.
Yeah. And also, just to add, SIF is on a mutual fund platform. So it is a version of maybe some advanced tool available to the fund manager to operate in that segment of derivative. And they have to again work with the guardrails that has been provided by the regulator, saying within this framework you can operate, but the platform remain mutual fund, and they have positioned it differently by naming specialized investment fund. If I may add to that. Yeah, I don't think so. There are any other questions, but Rupa, anything else? Anyone, if they have pointed out any other questions which are there?
I guess they are the only ones, Rahul. Uh,
Any other
any
closing
other
remarks,
questions?
Rupa?
Another minute or so. If you have any of the questions, audience, please share it in the chat box.
We have also been hearing, Gaurav, this asset class will become equivalent to hybrid, which is a large number we have been hearing over time. How are you seeing the traction?
No, I think it's early days, but the traction has been very good. I think the key challenge so far was the fact that there is this derivatives certification for people to distribute this product. I think
Mhm.
that number of people taking that exam and passing it is still very small when you think of the number of distributors in the country today. But that number has been steadily increasing. And I think as that number keeps increasing, you will see more and more awareness for this product. And then the other challenge obviously was that this is a new category, so people do not have a track record or enough sort of information about the product. I think those two challenges only with time will get resolved, but I think it's been a very welcome steady progress on both those fronts. So far no complaints about the ramp up that we've seen.
Sure. And one more thing on the operational front, how is the redemption, investment, NAV frequency?
Right. So SEBI has classified this category of SIFs as interval SIFs. What that means
Okay.
is that we can have daily investments, but we can have
Okay.
only redemptions on 2 days of the week. So every week you can have 2 days of redemption. And that apart, the NAV is published on a daily basis. So daily NAV, daily subscription, and twice a week redemption.
And those are things like Monday, Wednesday. Only on those days you can give
So, I mean,
redemption.
so far we are working with Mondays and Thursdays, but we are
Okay.
also attempting to change that Thursday to Wednesday. So going
Okay.
forward, most likely it will be Monday and Wednesday, but at this point it's Monday and Thursday.
Sure. Okay.
One
This is.
question from one of the
Sorry, can we make it the last question because I have
yes, this is the last
another
question.
25
Yes,
minutes.
yes. Usually, I mean, with liquid funds being taxed as per marginal taxation, arbitrage was being alternatively used as a recommendation to move into destination schemes as a strategy. Now, with SIFs, would that be can that be considered at any point of time?
So I don't think that you should think of this product as a parking vehicle, if that is the question, because as I said, there is some variability here. There is a 5% standard deviation. There are chances that some months can return negative as well. And which is why, as I said earlier, that from an intent point of view, 12 to 18 months, or in fact 18 to 24 months should be the right time frame to look at this product. That said, if you think of drawdown risk, those risks are not very high. taxation is equity, there is liquidity, there is no exit load beyond 1 month. So you have all the flexibility to take the money out whenever you want. But I would still think that from an intent point of view, the intent should be to think of it as 12 to 18 months in the bare minimum and 18 to 24 months in an idle situation as the investment time frame.
Thank you so much, Gaurav. I guess
Thank you so much.
we have
Mhm.
come to the end of this discussion. It's been really insightful and truly a very insightful discussion. Thank you so much, Gaurav and Rahul. And thank you, audience, for joining us for this wonderful webinar. And we would like to take your feedback, and we'll be sharing the feedback form, which will come to your mailbox. Request you to please respond to it. Your inputs help us make every session better. So, with that, we officially conclude today's session. Thank you so much and have
Thank
a
you so
wonderful
much.
weekend.
Thank you so much, Gaurav. Thank you,
Thank you so much. Thanks
participants.
for
Thank
having me.
you.
Thank
Bye-bye.
you. Bye bye.